Hey everyone, when we talk about electronic sector of India, the first name that comes to our mind is Dixon Technologies. It is undoubtedly the poster child of India's electronics manufacturing hub. Company went public in 2017, but stock underperformed till 2019. However, since then, Dixon has been one of the biggest wealth creators. Although, after reaching highs of 19,000 earlier this year, its stock price has crashed all the way to nearly 13,000. That's a 30% correction. By the way, Dixon is not the only electronic company that is facing the heat at the moment. We recently discussed the fall in Kaynes Technology. Also, PG Electronics has fallen brutally. The big question is, what is happening with the electronic sector? Is the growth story over for Dixon? Or is it just a healthy correction in a high quality stock? Or is the market signaling deeper problem? In today's video, we'll break the rise of EMS sector, what factors resulted in massive re-rating, and why 2025 has been a year of correction. Second topic we'll discuss is what factors triggered correction in Dixon share price. And finally, the big question, what should you do as an investor? Should you utilize this opportunity to add Dixon, or should you sell it or just hold it? Now on this, the investor community is completely divided. So we'll first understand the supporters' argument. Why do some investors think this fall is a buying opportunity? And then we'll look at the bearish argument. Why do others believe the stock can fall even further? Based on that, we'll take a call. What should you do going forward? Alright, let's get started. So if you look at the growth drivers for EMS sector, first driver is China plus one tailwind. Post-COVID, global brands wanted to diversify away from China, and India became a big manufacturing alternative. Within that, EMS firms were the direct beneficiary. For the first time, global OEMs were actively reaching out to Indian contract manufacturers. Second driver was PLI scheme that changed the game. The government literally incentivized companies to expand capacity. Mobiles, consumer electronics, IT hardware. This triggered a massive capex cycle. Companies like Dixon, Kaynes, PG Electroplast, they emerged as early mover with their scale, certification, and strong customer relationship. Then third factor was demand boom and domestic substitution. Domestic demand for electronics surged. At the same time, government pushed for import substitution like TV, mobile, AC component, washing machine, lighting. EMS players grabbed this opportunity and kept adding new product line every year. Fourth factor was re-rating due to high growth manufacturing tag. EMS sector was suddenly seen as India's answer to Vietnam, China manufacturing. Companies started growing at 50-60% CAGR rate. Even analysts went gung-ho on EMS sector and projected very high growth in coming years. Because of this narrative, everyone wanted a pie in EMS space and the stocks got aggressively re-rated. Some company traded at more than 100 PE multiple. So valuation became the biggest problem for the EMS sector. At PE of more than 100, market is expecting flawless execution. Sure, EMS is a high growth sector, but it also has its own set of challenges or risk that people neglected. First of all, people forget that EMS is not a software model. To grow revenue, EMS companies must keep investing in new plants. It's a continuous capex cycle. And when capex is heavy, returns look great only as long as utilization is high and demand is strong. The moment your growth slows down even slightly, your ROCE compresses and the whole sector derates. That's one of the biggest structural concern with the EMS sector. Then second issue is cash flow constraint. Companies like Kaynes, PG Electroplast surely reported strong profit growth, but they reported weak operating cash flows because working capital kept expanding. Then third issue is dependence on government PLI scheme. Let's be honest, a meaningful chunk of profitability expansion in the EMS sector has come from the PLI scheme. But whenever the market senses any uncertainty around the subsidies or be it tariff changes or slower PLI payouts, sentiments weakens instantly. Investors don't like a business where part of the economics depend on government incentive structures. So while the growth of the PMS sector has been extraordinary, this sector has its own set of challenges. Considering all these factors, a P multiple of 80, 90, 100, they are not sustainable. It only happens during the euphoria phase. And 2025 was the year of realization. Now let's understand the specific reason behind the fall in Dixon share price. So first reason for fall in Dixon share price in 2025 is end of PLI for mobile manufacturing by March 26. In mobiles, Dixon operating margins are typically just 2 to 3%. So even a small incentive from PLI meaningfully lifts EBITDA and net profit. So now with current PLI phase nearing completion, along with rising competition and constant price negotiation from OEMs, it has created doubt on whether Dixon will be able to manage its growth trajectory or not. Even management in the con call have mentioned that if PLI gets discontinued, there will be pressure on a couple of quarters in FY27. At the same time, the market sentiment around electronics, appliances, consumer durables have softened. When consumer discretionary slows down globally, companies like Dixon take the hit through lower order flow. And finally, valuations were stretched. At 19,000 level, Dixon was trading at a PE of more than 200, which was an insane valuation. Put all this together and the stock started correcting. But now, after the correction, Dixon PE has fallen to levels of 60-65. The big question is it a buying opportunity or there is more fall ahead? So I did some research to understand both buy and sell side argument. Let's have a look. Let's first start with supporters' view. Why some investors think Dixon is a buy now? First of all, the Make in India plus electronics manufacturing shift is still real. Global brands want a China plus one strategy and India is the biggest beneficiary. Dixon is still one of the largest and best positioned EMS players to capture that wave. Second argument is Dixon is not just a smartphone assembler anymore. It is expanding into laptop, wearable, appliances, lighting, TV, and even exploring display component. This diversification reduces the risk of dependence on a single category. Third argument is company has a long track record of execution. Over the years, Dixon has scaled revenue, added customers, and executed plant expansion faster than many peers. Fourth argument is exports and global orders could become the next big trigger for company. If Dixon cracks the export market in a meaningful way, the re-rating can happen in a big way. And finally, supporters argue that after a 30% fall, the risk reward becomes more favorable. If FY26-27 growth stabilizes and new orders materialize, this stock can rebound strongly. Supporters basically say that this is not a broken business. This is a strong business going through a demand cycle correction. Now let's look at the bearish view. Why others think the stock may fall further? So first argument is Dixon has client concentration. Recently, company lost a chunk of volume from one major client, Motorola, that raised concern about how dependent Dixon is on a few relationships. If one more major client reduces allocation, revenues may take a hit. Second argument is competition has gone up sharply. More EMS players are entering the market, like Carbon winning orders from Motorola is a reality check. Dixon won't automatically get every new opportunity. Third argument is the golden period of PLI may be over. In early years, PLI massively boosted volumes and margin. Going forward, benefits may taper and companies will have to grow without that push. Fourth argument is new segments like display panels are extremely high capex and high risk. If they scale slowly or face delays, investors' patience can run out quickly. Fifth argument is even after correction, some analysts believe valuations are still not cheap, especially given the uncertainties. The market may be pricing in another 10-20% correction before stabilizing. And finally, Dixon's earnings are tied to consumer cycles which are currently soft. If global demand drops further, order books could weaken. The bear argument is simple. The story is good, but the risk is still high, so wait for more clarity. Now that we have discussed both the arguments, let's look at what should you do with Dixon. Okay, let's first look at what smart money is doing. So FIs were consistent buyers in the company between March 23 till December 24. They reduced some stake for next 2 quarters, but DIs added it. In latest September quarter, both FIs and DIs have increased stake and public holding has reduced. Even number of shareholders have reduced significantly in latest quarter. Promoters did reduce their stake by around 6% in last 12 quarters, but FIs and DIs collectively hold around 50% stake in the company. Clearly, institutions are showing confidence in the company. I'd like to keep a close eye for next quarterly update. In any case, everything will boil down to execution over the next 12 to 18 months. If the earning growth is on track, Dixon can continue to maintain higher valuation. If the growth momentum reduces, stock can see more corrections. But here, one thing we must understand is, just because Dixon has fallen from PE of 200 to 60-65 does not make it cheap. We often ignore the base effect. Dixon's exponential growth in last 5-7 years came from a very small revenue base. So growing from 2,000-3,000 crore revenue to 48,000 crore is possible, when the base is small and new categories keep getting added. But today, Dixon is already a large-scale EMS giant with almost 48,000 crore top line. At this size, maintaining the same hyper growth becomes structurally difficult. Every 20% growth now means adding nearly 10,000 crores of new revenue. So investors should track whether growth normalizes to 20-25% instead of 45 to 50% CAGR that has been seen earlier. Because the valuation you pay should match that new growth reality. And going forward, earning growth trajectory would be the key. Now, if you are a long-term investor and holding Dixon from lower level, it is not a time to panic sell. The long-term EMS story is still intact. Yes, margins will normalize if PLI expire. But even without PLI, Dixon's scale, cost advantage and diversification make it a long-term compounding story. If you want to accumulate this dip, I would suggest don't be in a hurry. Let the dust settle down. Obviously, a PE of 60 is not cheap. It's just that stock is less expensive than before. Ideally, I would like to buy it at a levels of 40-45 PE, but I'm not sure if I get such an opportunity. The problem is, even today, after so much of correction and consolidation, the companies that are growing at a higher rate in India still command a premium valuation. So value buying opportunities are limited. Overall, Dixon is not a sell, yet not a screaming buy. I'd like to monitor the earning growth, margins and PLI development before accumulating the stock. For that, I would keep a close eye on companies' quarterly results and important communication. In case you do not get enough time to research and track the business closely, you can explore my weekly video series where I closely track around 200 companies and share my own investment strategies, but only for serious investors. The idea is to empower you with right information so that you can take your own investment decision. For more details, you can explore my website or join button of this channel. Now you tell me in the comment, what do you think about Dixon? Is it worth adding or there can be more correction ahead? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.